Unit 1, The Financial System, Lecture 9, Efficient Market Hypothesis and Fundamental and Technical Analysis. When we're doing an analysis for the purposes of asset selection, whether it's individual assets or assets within a portfolio, there are different ways we can do it. Two major methods are technical analysis or fundamental analysis. Now, technical analysis, which we're going to start with, involves studying past asset price series and trading volume information or data in an attempt to profit from periodic changes in the trends. So, with technical analysis, essentially people or analysts who use this particular method of analysis literally just look at what has happened in the market in the past. So, what prices did shares trade for? What volumes did they trade for? And they chart the past price series and trading volume information. And they look for patterns. They look for particular trends or behaviors within those graphs. And then using that information, they make a decision on whether they're going to buy or sell. Now, the other method used by analysts is referred to as fundamental analysis. Now, with fundamental analysis, the analyst focuses on determining what they call the intrinsic value of a share. So that value will be dependent on the nature of the business, the financial reports, the strategic direction. They're looking for the actual or implied value of the share from what is in the balance sheet, what kind of assets they have, the quality of their earnings, and so forth. So the emphasis in fundamental analysis is on future earnings and its quality. So as I've mentioned previously, with fundamental analysis, it requires the analysis of all variables that affect the level and growth rate of a company's earnings, such as the quality and depth of management, the competitive position of the company, the strength of the company's balance sheet, economic, technical, political, and the legal environment in which the company operates, and the characteristics and environment of the industry within which the company operates. One of the most debated and controversial questions in finance, and it's talked about a lot, is whether or not markets are efficient. Okay? Whether price movements of financial instruments can be predicted, or are they just random? Can we build models that can help us determine future prices, or are we watching waves in the ocean? According to the efficient market hypothesis, at any given time, financial instruments fully reflect all information, all available information. But that depends on what kind of information you're talking about and which of the efficient market hypotheses you're referring to here. So there are essentially three forms of the efficient market hypothesis, and we are actually interested in the impact that each of them have on the various investment analysis techniques that we use when making investment choices and decisions. So the three forms are the weak form, the semi-strong form, and the strong form. Now, the weak form efficient market says that all past market prices and data are fully reflected in asset prices. So if you go to the stock exchange today and you look at the prices of any of the companies trading on the stock exchange, those prices, according to the weak form efficient market, reflects all the information that you could get from past prices and past volumes. So what this means is that technical analysis won't be able to assist us in outperforming the market consistently. So even if you try and study them as much as possible, given the fact that all the information is currently in the prices, technical analysis is actually not effective. Now, the semi-strong form market says that all publicly available information is fully reflected in asset prices. So any information from company reports that are put into the market, prices react instantaneously, and that information is fully reflected. So what this says is neither technical nor fundamental analysis can be used to produce excess returns. So Using information in the market from past prices and volumes, or any publicly available information about companies, is not going to help you to earn excess returns using fundamental analysis. Now, the strong form of the efficient market hypothesis, all information, public and private, and this includes insider information, is fully reflected in asset prices. So the implication here, of course, is that you can't even use inside information to beat the market. Obviously, we know this is not true, and I don't think any market is strong form. But those are the three forms, and a lot of studies are being done at the moment and have been done in the past to determine which type of efficient market hypothesis is represented by the various markets around the world. So as we come to the end of this lecture, I believe that this slide summarizes very effectively the tie-in between the three forms of the efficient market hypothesis and the effectiveness of technical and fundamental analysis in producing consistent outperformance in each of these markets. As you can see, there is no possibility of outperformance using either technique if we're looking at the strong form efficient, semi-strong form, no outperformance using technical or fundamental analysis, consistent outperformance that is, and with the weak form market, there is no consistent outperformance with technical analysis, but there is still some hope for fundamental analysis.